Hello everybody. So in today's video, I just want to go over some research that I did on 11 different stocks. I kind of spend my evening looking at a few stocks and I'm kind of on a quest to find the cheapest hyper growth stocks right now. That's kind of what I've been looking for over the past few months. And HIMS was a good find, right? HIMS was really a gem, and I also love StoneCo, as you know, on the channel. But I'm like, are there other stocks like that? And really briefly, if you don't know, on this channel, I typically tend to look for growth stocks that are at the beginning of the adoption curve, of the product adoption curve. My goal is to not pay much on an enterprise value over gross profit basis. That's kind of a metric that I use, because by the time a company gets to the point where they're big enough, where they have strong earnings, right, I'm not going to have that growth that I seek anymore. So kind of the way of my investing style is I try to find a growth stock within a megatrend early on, enter, buy the stock, and get out as soon as their growth slow down. So typically the stocks that I analyze, typically they tend to be in the earlier stage of their development. And so the stocks that I've looked at today, many of them looked really, really good when they're recommended to you or when you hear about them. But when you look under the hood, for my style, they're not a good fit. I just want to go for two honorable mentions first. So first of all, Twilio would be a definitely good value right now per everything that I look at in a stock. It's the mobile communication stock, right? All of the SMS, the codes that you get whenever you want to log in, that is what they do. Twilio, clearly a battleground stock, lost, I don't know, 85% of its value or something like that. But to me, it looks like an outstanding value per the metric that I look at. And one of the other metrics that I look at is enterprise value over gross profit over revenue growth. It's kind of my spin on the PEG ratio, and I try to pay the least amount possible for each percentage point of growth. So Twilio has an honorable mention. Another one is Alteryx. Now, I've known about Alteryx for a while. I actually looked at Alteryx when it was at its peak, and I never bought in because I thought it was too expensive back then. But right now, to me, Alteryx looks like a really good value. It's a data analysis stock. It's a stock that makes analysis and statistical analysis easy for all of the employees within the organization. So honorable mention for both Twilio and Alteryx. And I think I'm going to cover these two stocks, but that's probably not what you came for. You came for the new HIMS. Is there a new HIMS out there? And per what I found, there could be a new HIMS out there, a mini HIMS as I like to call it, which is this micro cap called LifeMD. It's $35 million. And I have no way to explain this microcap except the fact that probably no one has noticed. And actually, when I look at the short ratio on this macrocap, I'm like, shorts have not even noticed it. You know, like typically shorts will short all innovation stocks altogether. And that's why most of the stocks on the channel that I cover, they have, 15, 20% short. This company is so tiny that it's not even being shorted. It's just entirely forgotten. I don't know what's going on. But think about that. This is a company that's $35 million in market cap, right? In enterprise value, enterprise value, $35 million. And it has $118 million in sales. It's had trailing 12 months, past 12 months, it has had $118 million in sales, and it's trading at $35 million. This is a ridiculous valuation. It has 83% gross margin. That's nothing to sneeze at. Analysts expect 60% forward revenue growth, and this is very, very impressive. Notably, what's even more impressive is that their earnings are tomorrow. So I'm not going to buy before their earnings because I want to learn about it. But they're about to become cash flow positive, which means that much of the reason why some stocks, sometimes growth stocks, trade super cheap is because the market is fearful that they're going to go bankrupt. But once the company becomes cash flow positive, you don't have that issue. You don't have that fear anymore. And they're about to become cash flow positive to the best of what I can see. So that risk of bankruptcy, in my view, is mostly gone, right? Then you can just focus on the growth and on the business and on what they do. And when I look at what LifeMD do, I look at it as a mini HIMS. They have slightly different of a focus than HIMS. They focus on family medicine, like if you have a cold or something, or a rash, went in the forest, you got a rash, poison ivy or something. They focus on family medicine, and they really focus on, targeting customers where you can't really go see a doctor, or you don't have a family practitioner, they don't have any room, and you don't want to go to the ER. I think that's what they focus on. They pair you with a family practitioner within 24 hours. Of course, it's entirely out of the insurance network, which I love. It's one of the reasons HIMSS has been thriving compared to Teladoc, is you don't have to go through you don't have to jump through the hoops of your own insurance, right? You don't have to figure out your insurance card and figure out how much it's going to cost. It's all outside of insurance, and it's cheap, right? And so you would see a family practitioner for, say, a rash or something, or a cold or a flu, and then the family practitioner would give you a prescription, and then what they'll do is they would send you a prescription card, and then you take that prescription card, something like GoodRx. Like if you live in the US, you probably know what GoodRx is. You just download this coupon online and you get 75%, 80% off. So they provide you a GoodRx type card, and then you would just go to CVS or Walgreens, give the card, and then you get a discounted price on the drug. So different business model to HIMSS. I do not think they're a competitor, but I do think they have an interesting niche in there. And from what I've started researching, because I'm definitely going to research that one going forward. What I've looked at is they seem to have an important business in international consultations. Seemingly, like a lot of places you can't get doctors, or like sometimes you'll have like a free healthcare system. It's free, so that means you gotta wait like 6 months to see someone or something, to see a family doctor. So they'll have a lot of their business from abroad, which I thought was very interesting. That you would have people who would just pay to see a US doctor and just forget about the money and pay whatever they charge, which is probably cheaper than a lot of what insurances charge, or a lot of the going rates for doctors. So, because it's all digital. So I'm very, very impressed by LifeMD, but that valuation, oh my goodness, that valuation is crazy. It's absolutely crazy. It's 0.4. Enterprise value over gross margin is a 0.4. I've never ever seen that in the spreadsheet. And it's a 0.01 for each percentage point of growth, which is dirt cheap. The only way to explain this, and that's why I titled this video Anomalies, looking for anomalies. The only way to explain this is that this is an anomaly in my view, and I don't have a problem waiting for an analyst report. Like this is to me a stock that I can easily take 50% if they have good earnings, because it's so unnoticed. I don't know what's going on in this market, not noticing innovation at all. Moving on though, Lovesac, another one that is very surprising to me. Lovesac, I would have never thought in all of my screening time that I would find a company like Lovesac score so well on my metrics. So if you don't know Lovesac, typically in the US, if you go to a fancy mall, you're going to see, you're going to have a Peloton store, and then next to a Peloton store, you're going to have kind of this hype brand, you're going to have a Casper store, and oftentimes you'll have something like a Lovesac store. These are these kind of new brands. There's a little bit of hype around them. They were very, very popular in the late 2010s, I would argue. And Lovesac actually is a very interesting company, from what I understand. They were very popular through their bean bags. They're still the leading maker of bean bags. A bean bag is this giant bag with foam in it, which is very interesting, right? I would it's interesting to me because I would never think that this company A would grow this fast, and B would score this well, right? When I see this valuation, I find it interesting. I may be interested in the furniture business now. But anyways, they have this new, the Lovesac is a customizable to infinity furniture. The whole idea is that you have this furniture that lasts for life, and you can reconfigure it into whatever use you have for your couch, from a bed to a storage trunk. And they also pride themselves on being child resistant. Anyways. But the point is, how could this be so cheap, right? How could this be? You're talking about a company that trades at under 1x sales with 52% growth, right? 52% gross margin, 30% growth, 52% gross margin, and they have a bunch of inventory. Actually, when you look at the balance sheet, they have $150 million of inventory. They have high inventory. They did the classic mistake, right? We have no inventory. In 2021, late 2020, companies overstock on inventory, and of course the inventory issues subsided, and because they subsided, they end up with too much inventory. This is literally a trend that you see in so many retailers right now where the inventory is too high. And I think the reason why the stock is down is because they may have to draw on their line of credit next quarter, but not that much, but they may have to draw a little bit of a line of credit because it seems like if they don't have a great holiday season, it seems like they may have to go in the red and draw on their line of credit, but nothing alarming in my view. Keep in mind that this is a company that spent, from what I saw, they spent about $600 on customer acquisition cost, and like the average purchase is like a $9,000 couch. So you spend $600, you get $9,000. You have a lot of levers in this company, right? It's one of these companies where it makes sense to invest in marketing. So anyways, I'm very interested in this company. I want to look more into it. It is dirt cheap. It is cheaper than StoneCo, and it is twice cheaper than HIMSS, and LifeMD is 10 times cheaper than HIMSS, so per my metric. So this market is absolutely crazy. There are anomalies out there. It feels like Warren Buffett going through the pink sheets in like the 1960s. If you hear the stories of Warren Buffett and how he started doing value investing, these are definitely anomalies to me. These are complete anomalies. For Lovesac, I will be waiting for the earnings call, which I believe is in 5 days. So I'll be waiting for those, and I'll see. I'll be studying those and probably making videos on those too. Let me know, by the way, if any of the other stocks on the spreadsheet. Let me remove this so that you can see. If any of these other stocks on the spreadsheet you find interesting, feel free to pause and compare the numbers. If you find any of those interesting, let me know. If you have any insights on those, let me know. And I already said I would be thinking about making a few videos to some of you in the comments about some of these. But anyways, that is it for today. Thank you very much for watching. This is not investment advice, never, ever, ever, just entertainment. Please like, please subscribe. Have a wonderful day.